Thank you for joining me today. For those of you that don't know me, I'm Rob Wilkinson, co-founder of property crowdfunding platform Crowd With Us. I'm very pleased to be joined today by Helen Chorley, Rod Turner, and Antony Stark. I think it's fair to say that pretty much everyone's been affected by Corona in some way, shape, or form. At present, I'm speaking to a lot of investors and borrowers at the minute, and I thought it would be a good idea to bring a panel together of people that are actively in the industry in order to discuss a few points. So some things I'll be covering today is how they're being affected, or how they're being affected by the current situation, what precautions they've taken to date, how they're looking to or have changed their strategy in the way that they're viewing sites or projects, what their longer term predictions are, and anything else that crops up along the way. So I think it'll be a good start for everyone to introduce themselves. So do you want to start off, Helen?
Sure. So I call myself a professional investor. I invest in other people's development projects. So I'm not a developer myself. That's not my strength, and I don't have the patience nor tolerance for that. I've done a number of deals through Crowd With Us, but I also do JVs direct with developers themselves. I think we've got about 12 projects underway. So at the moment, currently, I'm sure we'll talk about some of those. My background is in finance. I was in investment banking for a number of years in foreign exchange. So kind of my skills are on the analysis side of things, and I talk a lot about due diligence and the questions people should ask, and I do a lot of speaking on those type of topics, trying to help people or stop people losing money and kind of safeguard their investments.
Perfect. Who's up next? Rod?
Hi, I'm Rod Turner. I've got a property investment and development company based in London, but operate in London, Manchester and Leeds. We do a bit of a mixture from residential to industrial and some specialist care stuff too. We're often building out, adding value through planning where we can, doing the build out, and then dependent on what the market's like at the time, we could be selling or holding in our portfolio. And I also host, I better give a quick plug here, also host a podcast called The Rodcast, all about asset-backed investments.
Very good, very good. And last but not least, Antony.
My name is Antony Stark. I've been in the property industry in one way or another for 25 years. My company is Linea Homes, and we primarily purchase sites, normally commercial, with the view to adding value through planning. Some we build and some we sell on to other developers who can go ahead and build them out and probably make more money at building them out than I can.
Very good, very good. And how are you all enjoying the social isolation?
I'm twice as busy. There's nothing kind of isolated or relaxing about this. Seriously, I'm like on conference calls and stuff till midnight. Okay, some of those might involve a glass of wine, but yeah, I'm really busy. It's good though, it's great.
Same for everyone. I'm finding that it's much more productive actually having all your meetings over Zoom than traveling from one location to another.
Yeah, I definitely think
things get a lot more.
You can get a lot more done.
Yeah.
I think being at home, the only additional problem to that is my wife works and our cleaners have gone. So with my OCD, I'm running around the house. I probably spend more of my time cleaning floors than I do anything else, and trying to get teenagers to clean their bathrooms, which is not an easy one.
Yeah, I'm in a similar boat with younger kids, so just cleaning up after them, really.
Exactly.
Excellent. So that aside, how has the present situation, other than working from home, affected you all? Who wants to start?
I don't mind. It's the feeling from agents is that there's people still talking, but I think there'll always be people still talking in terms of buying. I think the reality is that you can't get valuers out. So, for instance, I've got one of my developments in Enfield where we've got 5 houses, 2 have sold, and this one went under offer just as COVID-19 was starting to happen. They've got a mortgage offer, but they can't get a valuer out. Even though the government's advice is, if there's no one living in the property, there's no reason why the valuer can't go out. So you're pushing water uphill. That buyer tried to chip the price, but they were already at a fairly competitive price anyway. The market was only sort of starting to come back from January anyway, from the Brexit shenanigans. And that's, in terms of viewings on the other houses, it's just not happening. No one's going to be buying at the moment from a residential end user sale point of view. We had a site in Barn 2 weeks ago. We managed to get it out of the council, and we had 4 buyers, 3 dropped off, 1 performed. So we got an exchange last Friday gone, which was excellent. Which gives me confidence that there's buyers out there. I would imagine he's cash. It's a £1 million purchase, so it's not a particularly big purchase. We were buying a site in Hertfordshire, which we were going to get planning, hopefully go for planning for 200 plus units, and the valuer was still there for it, and then he changed his mind. He wasn't there for it, and our investors slowly, I think we have 4 or 5 investors, and they all slowly sort of turned off it. So we're now looking at trying to do a subject to on that, which I think would just buy a little bit more time. Then we've got a site in Greenwich. Problem with that, we've got a resolution to grant. They're supposed to have gone to committee last month. It was now supposed to go to committee on the 7th of April. Greenwich Council can't tell us if they're going to do that. They're definitely not going to do an actual face-to-face meeting. But the government on the 25th of March passed emergency legislation which says that councils have to look to technology to do Zoom conference committee meetings, and the head of planning in the local authorities can make delegated decisions in cases where he otherwise wouldn't. They won't make a delegated decision in our case because we've got 41 objections, even though we've got a resolution to grant. So we're just in the hands of the gods as to whether or not they have a committee meeting. And we've got a sale lined up to a housing association, and hopefully they're still there at the moment, and that's hopefully where it's going to end up. But I think the general feeling is caution, and you're not quite sure if it's going to happen, or if a deal's going to happen or not. I think from a purchasing point, that's when I'm selling. From a purchasing point of view, I can't really argue with that. I'll probably have the same feelings. What is the right price? How long are we going to be in this situation? Can you get it valued? You're going to get your investors in place. Can you get on site and build the thing? You can't get any suppliers. I mean, if I was on site now, I'd be really, really worried, because I'm hemorrhaging interest and I can't buy suppliers. So how are you going to finish your scheme? So you're at least 6 months back, whatever happens.
Yeah, that's some very good points there. But I think being on site, that perfectly goes across to you, Rod. How is the present situation affecting you?
Yeah, so yeah, we have one on site at the moment, which we shut down last week, we actually bulk ordered a lot of materials in 2 weeks before, because we kind of saw this really the writing on the wall, and organised a skeleton crews to operate. So that meant another issue, which was security on site had to be increased as well, because obviously suddenly we've got thousands and thousands of pounds of materials that are sat there. So we needed to make sure that they were looked after well. And then we ran on a skeleton crew for 2 more weeks until really it just became clear that we had sort of key personnel going into self-isolation, and it just made things very, very difficult. So we have put a halt on that. We will look to start it up again on a skeleton crew probably in 2 weeks' time, if nothing's changed. As far as supplies are going, yes, it's tricky, but we've I think we did quite well in getting a lot of what we needed there for the rest of the build. Finance-wise, we're not in a too bad a place on that one, so all things considered, it should still be pretty decent. We had another site where we had got planning, and we had 2 offers on it, and they've both gone away now. So it's again not the end of the world, because I'm a bit different to Antony. I do like to build things out, so I've got my way there. So it looks like we will be building that site out. In terms of the sort of portfolio, fortunately, a lot of our commercials are industrial, so they're actually doing okay. They're all pretty good, in pretty good shape and operating, and also they've got decent grants now. Grants from the government, so actually some of them are in quite a better financial position than they might have been before, especially some of the small businesses with the grants that they've received. Residential is a bit of a mixed story at the moment. We had checked our rents yesterday. First of the month came in. We were expecting 25% of arrears. Actually, it was 11%. However, we think next month's going to be quite a bit worse because we've got some changes of tenancies coming in. Certain sectors of that residential will suffer more. So one of the things we had done was stress test everything to LHA rates. And where you see the biggest kind of margin difference between the LHA and private rentals are with shared housing, so co-living stuff. Fortunately, for the last 2 years, we've been converting a lot of co-living back to single family stuff, but we still have a couple of sort of quite big ones. They're probably going to be most at risk, or are most at risk, and we're expecting to see some voids crop up over the next 2 months, I would have thought, because there you don't really see in your blocks of flats people leaving flats and moving. They'll rather stay put. However, in the shared housing, normally they'll go back to family, and so they will have an opportunity to move. So there I'm expecting to see a few more voids. And then obviously you've got 1 million people in 2 weeks have applied for universal credit. So regardless of what the government's trying to do, people are losing jobs, and that's on top of those already claiming. So obviously these LHA landlords, who are far and few between, are probably rubbing their hands now, because they've got essentially government-backed sort of securitized income there.
Yeah.
So I do think some of the private rental may suffer a little bit.
What about
that's where we're at the moment. It's there's definitely been some hurdles.
Sorry, I didn't catch the last bit there, Rod.
Sorry, Rob.
I didn't catch what the last sentence.
Yeah, I was just saying there's certainly been. I think I was just saying there's definitely been some hurdles, but I think we planned quite well for it. Although the situation moves so quickly, it's just keeping abreast of it. So things that we might have monitored on a monthly basis, we now find ourselves doing it almost daily, just because the situation is changing so quickly.
Okay, very, very good. And Helen.
So from an investment perspective, clearly, as we said, with all the sites shutting down, and I think particularly kind of the smaller SME space, tried to keep those sites going as long as possible. That means kind of delayed time frame, and where there are equity investments, then that clearly means you're going to get your return, if there is still a return, let's hope. But that's going to be kind of drawn out over a longer time period, which actually means your return on an annual a PA basis is going to go down. So, that's unfortunate, but that's kind of where we are. And I think that's one of my kind of principles. It's reinforcing, all of this is reinforcing a lot of the principles that I already apply. Like, I'm not relying on that money coming back when it's said it's going to be back. You know, a year's project, particularly if it's equity, never really ends up being a year. So I always add, well, I always used to add 6 months. Now I've started adding 12 months. And after this, I don't know how long I'll need to add, but it clearly affects the overall return. But kind of what we are where we are, and let's just hope we can get kind of back on site when all this is passed as quickly as possible. In terms of the debt types of investments, so where people have issued bonds, then that money is getting paid. You know, it's effectively, it's a loan. That money is getting paid, and that's actually why I went in. I kind of switched strategy a couple of years ago and started taking on more asset-backed debt type investments because of other, you know, actually kind of inherent kind of market problems and Brexit, but was extending time frames on these projects. And I wanted to be paid for the whole time that my money was out on loan and being used. So they are still, you know, kind of, it's good from an investment perspective that still is still being paid. Yes, conversations with the ability of the developers to kind of keep financing. That's their financing costs, and the more this time goes on, then those will be extended. And normally in bond or those type arrangements, there's a penalty clause or a penalty type interest rate once you go over the kind of the time frame of that loan. But I think, you know, these are kind of absolutely uncharted waters, and I think there needs to be a bit of kind of understanding and kind of compassion and you know, kind of talking to developers about exactly how and when those things are applied, because this is nobody's fault, right? So it's you know what, the really important thing for me and what I would like people to take away from this is that, just particularly from an investor's perspective, please keep communicating. You know, it rings alarm bells so much when developers stop communicating and you don't know what's happening. Are they on site or are they not on site? And what's the plan? Has the plan changed? All those exit strategies you should have talked about at the beginning, are those still relevant? Are those still options? You know, just kind of, like I say, keep those channels of communication open. And I know everybody's fighting fires, so I haven't kind of hassled any of my developers too much. You know, I'd rather them just get their own business and the project sorted and get all that on track. But over the next kind of week, 2 weeks, I will be reaching out to say, you know, shall we kind of like talk about this, kind of what's going on, what are the plans? So that's what I would ask for and expect.
Okay, so you've kind of answered the other question I had there, was what additional precautions you're taking. So more frequent communications with the borrowers and the developers that you're working with, and obviously adding longer timeframes to your equity projects.
Yeah, absolutely. I mean, like, as I say, I never expect or I never count on that money, that capital coming back when it's due to be back. I never, you know, I'm not like, right, I have to wait for that to come in before I can do something else. That's not the way I work. Cash flow is completely king. But, you know, while people can't be on site and doing physical stuff, you know, to the degree that they were doing stuff before, things can still be done. You know, kind of what's happening on the market front, you can still get those brochures underway. You can still get those, you know, homeowner packs when you need to sell, you know, the houses at the end of it. All that stuff, that's going to be done in an office and can be done at any time anyway. There's stuff that can be done. So it's just kind of keeping people focused on the stuff that can be done now as well.
Very good. So Rod and Antony, have you got, I mean, we've covered a lot of it already, but anything to add on additional precautions that you've taken?
I think it's looking at your cash flow, looking at where your money was going to come in, and trying to establish whether that's still going to be on target. And if you think there's going to be some issues, then it's best to talk to your borrowers early, to the lenders early, And I think, as Helen said, if you're keeping everybody abreast of the situation, you're probably going to be in better place than if you just try and bury your head in the sand like it's not happening. You know, we've looked at our cash flow, and I think we're quite fortunate. We got that exchange through. The guy's put 100 grand on the table. I can't see he's going to fall over, but we're still going to go and put our senior debt in place. They're a bank that we've worked with for 15 years. We've got a personal relationship with them, but their current position is that they're not lending to anyone new, and they're not lending to anyone who wants to get on site. And I'm hearing across the board that a lot of bridging loan companies are pulling out. I would imagine a lot of the senior lenders are going to be only talking to their existing client base. But I think, you know, there's flexibility if you've got money out. I think you've got to be with the right bank and have relationships. But every site's different. You know, one thing I wouldn't want to be, we don't have any aggressive debt. We're not highly geared. I think if you are highly geared, it's going to be quite stressful. It's going to be very stressful. And I think, especially if you're lending on, if you've got second charge debt in, mezz debt, stretch debt, it's that no one saw coming, and you can't really budget for it. But in terms of answering your question, I think communication is the key, and making sure you know exactly what you're doing going forward. I mean, I thought it'd be amusing to speak to Barclays, who have offered us zero support at all during any of our business over the last 10 years. That all they do is charge us for running our accounts. And I just thought it would be fun to say to them, look, well, what happens if my exchange doesn't happen? How are you going to help me on the back of the fact the government are going to give you an 80% guarantee on an unsecured loan? And their answer was, we're not. And I went, that's good. Thanks. So, you know, I think these CBILS loans are not going to be for anybody in properties. So you can forget about that 100%. So I think it's managing what you've got come in. I think, as Rod said before, we've got a portfolio of buy-to-let. Fortunately, it's not huge. I think we've got about 20 properties in there. All of them this month have paid, but I know there's going to be some pain. We've got rent guarantee on all of them. Haven't checked the insurance policy, but who knows? They'll probably try and have a wriggle. But then I suppose it's just, can you weather the storm? Can you speak? Maybe we need to speak to our lender and say, look, you know, you need to give us a bit of time. I think we'd get some flexibility, but I think that it's our tenants are all professionals. I think we should be all right. I think in worst way, they'll probably be having been put on furlough, and they'll still know they have to pay their rent, and they don't want to have to pay it in a year's time. So I think for now, I think it's being open to the fact they may well be picking up the phone again, they're not paying their rent, and how you're going to address it.
I think that communication there is key, though, because I've had a couple of tenants phone me up asking if they can go on a payment holiday. They just think that it's a freebie by the bank. So when you explain to them that they're going to have to catch up that rent at some point in the future, the two people that phoned me up, two different tenants, they actually changed their tune and said, okay, we'll continue paying. So again, that's where the communication comes in. Rod, have you got anything to add on that? Any additional precautions or any thoughts?
Yeah, I mean, a lot of echoing what Antony said there, and yourself really. We had a couple of people contact our lettings management guys we have one person that was very proactive who's actually stuck abroad in a lockdown there, and their tenancy is coming to an end. So we've worked quite a lot with him. He's been really proactive, and so happy to kind of help in the situation. At the same time, we've then had to be chasing up other tenants who have informed us that the government has told them not to pay rent and things like that. So again, once you communicate these things to them, it becomes fairly obvious that actually the situation might not be as completely truthful as what they might have said, and they quickly change their tune once they realise other things have to they will pay eventually, or increases them from time to time. But again, it's communication. We're happy to help people where there is a real need, and it makes sense for us to do that as well. Again, going back to kind of the development stuff, following on what Antony said regarding kind of debt and things like that, we're in a decent position because the sites we bought, we were looking at sites that cash flowed from day one, and then we could get the planning uplift on that to then build out. So if we don't start building, it's not the end of the world. We're still in positive cash flow. The one that we do have is under construction right now. Again, we haven't got large amounts of debt on it. We're in a fortunate position there. So again, the extra time, I'm fairly neurotic about stress testing these sort of things. So that's now helping. And again, stress testing all different types of scenarios. It's looking at, right, what's the worst case scenario? How can we adapt to get that better? How can we lower our expenditure? What are the type of things we need? Look at cash flow forecasts and understand, right, okay, if we need to be covering this expenditure is vital, what do we need coming in to do that? So all those sort of things, and then it comes back onto what are the opportunities here. And I thought it was really interesting what Helen said about the last couple of years moving from equity to debt, really on that kind of IRR model, because then she wasn't exposed to increase in time. I actually think now, well, not now, maybe in a year or 6 months, that's going to change back to the equity model, where fixed income will be eroded by some of that inflation that's inevitably turn up here now from all the stimulus that's being pulled in. And actually the equity model might start to be a little bit more positive as time goes on. Your fixed income won't be eroded. So I think there's a lot of changes coming and happening right now. And I think the businesses that will do well are those businesses that are easily adaptable to changes, which in property, especially because it's quite long term, and things don't move particularly quickly. So it's where businesses can and are able to adapt. I think they're going to do really well.
Very good, very good. So yeah, you moved on to your longer term predictions there. So that was good. And whilst just to keep on that then, Rod, how's your strategy personally going to have changed, or what are your thoughts on that from now and going forward?
Well, again, I mean, what I'm going to be looking at is who ultimately underwrites the income I'm going to receive. So if I'm developing out a product, I want to know where that income is going to come from. So even if you're selling to owner occupiers, it's okay, well, where's the income coming from them? Is it going to be the professional market for residential? If you're doing sort of commercial stuff, again, what are the type of businesses and how is their income underwritten? Because if you've got businesses that are coming from, I don't know, government sources, and you've got securitized income coming from that in terms of, I don't know, you might have care facilities, again, student stuff, not right now, but maybe in 2 years. So if you're building now for that position, could be really interesting. I think I said about LHA tenants and things like that. That's obviously, LHA has gone up, I think 13%. They announced last week. So there's not a huge difference. Like when we stress tested our portfolio, and bear in mind we've got some decent stuff in London with sort of professional people renting them. Actually, the differences between LHA and market rents are not very big at all, unless you're looking at the shared accommodation stuff. So that was quite interesting there. I do kind of feel that with the unemployment levels, we may be seeing rents falling a bit in some of that professional residential stuff. Obviously, that's going to have repercussions. If wages are falling, that's going to have repercussions. So, like we spoke about with a lot of the unemployment increasing. But then, as a sort of contrary argument to that, with a bit of unemployment will increase productivity, because now people, when they're trying to hire, are not doing it based on, well, if I've got to hire, I've got to pay them more. And so hopefully some productivity will start to increase. So at the moment, I'm finding it very, very difficult to call. But I'm personally putting things in place which allow me to maybe benefit, or maybe benefit is the wrong word, but allow me not to be exposed to a situation where I've got all my eggs in one basket, where they're affected by maybe inflation or stagflation or even deflation. And so for me, that's quite important there. It's again looking at what you're doing and how any of these risks can expose your location, your tenant type, your use class.
Superb, excellent. So Helen, following on from that, your strategy, how has that changed, and then long-term predictions?
Well, I would completely agree with what Rod said, and maybe just to explain to people that when he's talking about kind of inflation and that actually eroding kind of, you know, the value of money and ultimately making kind of debt not as attractive. So I just was literally about to exchange on a JV deal just before this. So I've already started kind of looking at that, you know, a kind of shift back to what I was doing before anyway. I mean, that's a plan again. There was, you know, a lot of value in that deal. So it was very kind of specific. But what people aren't realizing is, you know, it's wonderful that the government's helping. That's great. You know, interest rates are down, everything. That's wonderful. This is quantitative easing. This is, which has been going on for a while. They're pumping so much money into the system. This is not free money. This has to be paid for at some point. This will lead to inflation, and also, you know, and ultimately that you know, that has a knock-on effect kind of down the line, because it's not immediate. All people see is, well, hey, there's free money going around. Yeah, that's got to be paid for, people. So I completely agree with kind of what Rod said about actually kind of looking at its debt still the kind of the right way to go. I'm certainly looking at, and because kind of where I am on my property journey, to use the NAF phrase, and I understand more, and I've spent a lot of time kind of researching and learning about kind of planning uplift and kind of those value added, if I can get out, type strategies. And that's what I'm in discussions with kind of various developers about as well. But something else kind of I was picking up from both what Antony and Rod had said is, you know, kind of speaking my language, I would call it diversification. You know, when Rod talks about LHA type arrangements, well, in my world, that would be like a kind of government debt. That's like an A-rated kind of investment. They have to keep paying. They are unlikely kind of to default. So if you have a bit of that, and you have a bit of student, and you know, you're doing an uplift deal, and you've got some asset-backed debt deals, then, you know, hopefully across that portfolio, and that's kind of what I do for myself. I'm effectively my own portfolio manager, and I'm managing the funds that I have across different kind of asset classes in terms of different kind of niches of the property market, because of the returns that are associated with those and the different risks. So it's keeping it diversified.
So I know one of your biggest things is capital preservation. So are you still actively looking now, or are you just taking a step back and watching what's going on?
No, I'm always actively looking. You never know when an opportunity is gonna kind of pop up. But I think you have to be kind of very, very selective right now. I know a number of people that agreed things, including me actually, you know, kind of in the run up to all of this happening. I think now you need to look back at those, you know, and if nothing kind of legal has been signed and your exchange or what have you hasn't taken place, I do think those things need to be looked at. Is that price still the right price? You know, nobody could have expected this, and you know, it's not a lovely conversation to have, but I think everybody recognizes that the world has changed significantly, and I hear the whole spectrum of expectations from, this is the, the kind of the doom and gloom. This is the kind of the depression that we've been expecting. It's going to be worse than 2008. We've been waiting for it to 2 years to, some people expecting that, yes, there will be a dip, but then the bounce back will be strong. Who knows? But if you can kind of position yourself for it in terms of cash flow and reserves, which I think both Rod and Antony have already spoken about, managing that cash flow, then that keeps you in the best position to be able to manage this going forward, because who knows how long it's going to last.
Indeed, some very sound advice. So lastly, Antony, I mean, we've covered a lot of it already, but how's your strategy changed going forward, and what's your longer term predictions, if you've got any?
I think for us, we always buy on what we're looking at in terms of today's value, and then what we believe that we can add in terms of value through planning, and what that end value is going to be for the residual value of the site on receipt of planning. The difficulty you've got is you don't really know where the market's going to take you over the next 6 months. There's going to be downward pressure. How far is that downward pressure? It's still cheap to borrow. I think unemployment's your biggest fear. I think if people haven't got jobs, they can't pay mortgages, but people still have somewhere, and there's a massive shortage of housing. I just think you got to buy time, and debt's expensive. And where we were potentially buying sites unconditionally, sitting on them, paying no income coming in as we're running through the planning process, we're going to be far more reluctant to do that, and we're looking for longer completions options, securing better prices. But a lot of the stuff we've been working on lately anyway has been housing association led. So our exit strategy has been to housing associations anyway. They are really difficult to deal with. But if you package them up rightly and you've got a lot of patience, you can do them. And they don't have a very, very small cost of fund. They're not looking to make profit. So the margins can be very good, but it's just picking the right sites that are going to work for them. I mean, having said that, they're not stupid, and they're not in a rush to agree anything at the moment, and I don't think anyone is. And that could be to an advantage to maybe pick up a site cheap, but you have to think about what's cheap and what isn't. And that's why I think going long and buying yourself a lot of time, even if maybe you're thinking, all right, well, the price is about right. If you're adding value, hopefully by the time you get to the other end, your margin may not be your margin could be better than what you think it is, depending on how long it takes you to get through planning. Mm-hmm. As long as you're not paying interest in the meantime and your cost of planning isn't obscene, I think it's a decent strategy. But what I did find in the run up to Brexit in that 3 years is nothing was coming to market, because interest rates were low, nobody was desperate to sell. Valuations people were putting on things, especially the type of stuff we want to buy where we need to have value, wasn't good enough. And now we saw a flip of that at the end of December through to January and February, and then coronavirus kicked in, and now you'll have a pullback again, and people that had sites where you could uncover value just won't sell. They probably owned them for a very long time. They've got no debt. They're being told it was worth £1 million 3 months ago, and now it's worth 500,000. They're going to go no. They might go subject to, or they'll just sit tight. So I think it's case by case, and you have to just take each day as it comes at the moment. I think we all want to come out of this as quickly as we can, but no one really knows when that's going to be.
No, indeed. Yeah, thanks very much, guys. That was really productive. I very much enjoyed it. Does anyone have anything else they want to add before we come to a close?
I think to just kind of like leave it on a positive note, that I do think there will be kind of opportunities. Yeah. Like Antony said, maybe some people who don't have to will hold off, but there are some people who maybe don't have perhaps as balanced a portfolio as they could have, And it's very unfortunate, but their hands will be tied and they will need to liquidate things. So I very much think there'll be kind of opportunities kind of going throughout this year. Am I ready to kind of jump and pounce on something right now? Well, actually, yes, I'm in a position to be able to, but I think those opportunities and the prices of those opportunities only get better through kind of going through this year. So I would just be, as I always do, it's not a great surprise, just urge people to be cautious, to really look at the value of those things, to really consider what the exit strategies will be, you know, because yeah, who knows what we're going to look like the other side of this.
I think that's really interesting because, as I said, I'm talking to investors, as you know, Helen, on a regular basis, and the last couple of days I've been talking to people that do have sizable pots, and they're still very actively looking for the right deal, albeit, but still happy to get involved.
And also, again, I mean, I said it already, but what you do there, you know, you do investor relations really well. And a lot of the developers that you work with do it really well. And I would just really encourage people that's how developers can kind of get themselves out of hole and kind of buy time and buy kind of understanding, by communicating, by letting the investors kind of into the world. This is what we're seeing. This is what we're faced with. And, you know, getting that human element.
For sure. Thank you very much. And Rod, did you have something there? Is he there, or is he frozen again?
Yeah, I think obviously. Yeah. So, can you hear me?
Yeah, we got you.
So yeah, to follow Helen and finish on a positive, I think. I mean, no doubt that it will be hard and harder than it's been to make money within this market. But it's not about how it compares to how it used to be. It's about how it compares to other opportunities in different asset classes, I think. And I still think there's going to be. I still think property will have good opportunity on that front when you compare it to what other opportunities are out there.
Very good. Well, I think we'll leave it on that note. So thanks very much for your time, guys. I'm sure that we're going to send this out, and we'll obviously send you the link. So I'm sure there'll be follow-up questions, which I'll send on, and maybe we could do this again sometime. So thanks very much.
Thanks, Rob.